Hey everyone, this is Dante. Today we're going to talk about the topic of liquidity. Now, liquidity is a word we use often at strategic trading. It's one of the key aspects behind our trading strategy. In fact, it's probably the top most important aspect of all. So liquidity is one of those mysterious words that gets used a lot, but I think most people don't really understand what it means. So today we're going to define exactly what it means, take the mystery out of it, find out why it's the key driver for behind market prices, see where it comes from, and really understand how we can use it in our trading strategy. So let's get started. So what is liquidity? Liquidity basically comes down to one word, and that is cash. The ability for the market, whatever market that is, the stock market, the bond market, the real estate market, the ability for a market to turn any asset, any financial asset, such as stocks, such as bonds, into cash quickly, easily, cheaply. That last part is very important. The easier it is to turn a financial asset into cash quickly, easily, and cheaply, and the more that cash is available on demand without causing too much stress to the market, the better liquidity is, the stronger it is. Liquidity at its core gives investors the freedom to act, the freedom to hold assets. The more liquidity there is in the market, the less likely these investors are to be forced to sell anytime there's stress in the economy or in the market. So basically, when liquidity is strong, investors don't have an immediate need for cash, so they're not compelled to sell. And in fact, what really causes prices to go up is a lack of sellers. A common misconception is that a lot of buyers are what's needed to push prices up. But in fact, you can have a lot of buyers, but if there are a lot of sellers as well, price isn't going to go anywhere. On the other hand, if you don't have a lot of sellers, all you need is one or two buyers, and they're going to push price up. Just a few buyers, because they have to go higher and higher in price to find someone who's willing and ready to sell their assets and take their cash. So when markets rise, it's often because of a lack of sellers. So when the market rallies on low volume, that's actually often a bullish situation, because it implies that people don't need to sell. There's a lot of misconceptions surrounding that, especially from the internet, that if a rally happens on low volume, it means it's bearish and it's fake and we should just sell it. But in fact, if a rally happens on low volume, it means there are no sellers. Sellers have lost control of the market. Anyone who wants to buy has to bid at higher and higher prices just to get in. It's the rallies where volume is very high that you need to watch out, because those rallies mean that there are a lot of investors who need cash and are willing to cash out of their assets. And those sellers are exhausting buyers. When volume is high as price rises, that rally is exhausting a lot of buying power in the market. On the other hand, when price is rising and there's low volume, that rally is not really taking much cash out of the market. It's not exhausting the market's buying power. So that's pretty much how it works. And when liquidity is high, you tend to see these low volume rallies more. So this quote here, for many events, roughly 80% of the effects come from 20% of the causes. This is a quote from Wilfredo Pareto. He is the creator of the Pareto principle. It's the 80-20 principle. Basically, it means that pretty much anything in nature, in business, and personal life, pretty much anything you can think of, just a few things make all the difference, while most things really don't matter at all. And to give a common example, let's talk about a business. And almost every business I've examined, has this going on for them. Say I have a business and I have 100 customers and I sell a variety of products. What often happens is that 20 of those customers, or often even fewer than that, account for almost all of the sales, profits, and revenues. Usually just a few customers account for all the profits, and the others don't really contribute anything. The same can be said of products. Say I have a business with 20 products. Just 3 or 4 of those products probably make up most profits for the company. And an easy example here is Apple. Apple makes, I forgot what their latest numbers were. They are declining, but I think over half of all of Apple's revenues and profits come from just iPhone sales. And we see this in almost every business. If you go through the S&P 500, diversified companies, and the S&P 500, you'll see that for almost all of them, most of those companies' profits come from just a few products. So this applies to the market as well. We often hear on TV, on YouTube, on the internet, all sorts of explanations on why something is happening in the market. Oh, the market's rallying because of trade news. The market's rallying because of China. The market's selling off because of the Fed. The market, they like this, they like that. They don't like this. And this is what caused the rally. This is what caused the sell-off. Well, I'm here to tell you that's just nonsense. All of that is just noise, basically. Because I can tell you, most of the market's moves come from 2 factors. When price moves, it comes from 2 factors. Supply and demand is factor number 1, and liquidity is factor number 2. Supply and demand is just the natural buying and selling pressure. People who want stocks, people who want to sell stocks. Sellers are supply, buyers are demand. Liquidity is the freedom with which those buyers and sellers have to act. Now, the more freely they can act, the stronger their position is, and therefore the more stability the market has. So let's go over what that exactly means. And the lesson, of course, there is just ignore the noise, focus on what matters. And let's look at why liquidity, which is one of the key aspects behind price movements, why is it important? Just how does it affect the market? This word we keep hearing, liquidity. Well, liquidity tells us how the market is likely to react to big news events. So say all those reasons that I just gave you that the media likes to tell us move markets, China, Fed, oil, political stuff, you name it. Well, all of that can happen and more, but if the market has strong liquidity, it's not going to have a huge effect, a huge negative effect at least. So if the market suddenly gets a shock from bad news, and that bad news takes price down to a major support level where there's demand, proven to be demand, that's what a support level is. It's a place in the market, a price in the market, where we have proof that there's demand waiting. Well, when there's liquidity in the market, sudden sell-offs at those levels tend to attract buyers and exhaust sellers very quickly. So that's what liquidity tells us. How the market is likely to behave around those major support levels. So regardless of what the news is, we can just turn the news off and not even look at it. In fact, there are traders out there, especially in the Forex market, who might go an entire year or 2 years without looking at any news, economic events, anything. They just look at the price action and liquidity data, and they do very well. I know 2 of them personally. And they don't need to know what the news is. They just need to know what the market's conditions are, because that's what tells us what will happen when price suddenly moves to one of those major levels. And the news is just an excuse. That's what moves the price there. But what we're really interested in is, what does price do once it moves to those major levels? That's what liquidity tells us. So once we have our major levels and we have liquidity, the market's liquidity, we can act with confidence around those major levels. So liquidity can also tell us whether breakouts might succeed and start a new uptrend, or whether those breakouts will attract sellers who will use those higher prices as an opportunity to get out and raise their cash levels. So when liquidity is strong, you won't see very many sellers show up. They'll just hold on to their stocks or their bonds or whatever asset because they don't need the cash. So you might get a back test in that breakout, but if sellers don't show up, price will start rising because buyers will need to move to higher prices if they want to buy in, if there are no sellers. So strong liquidity turns the big dips, regardless of the reason, into buying opportunities. Weak liquidity turns breakouts in the market into selling opportunities because when liquidity is weak, sellers are more likely to use that breakout to get out of their positions, to raise cash. And so that breakout is likely to fail if liquidity is weak. So, where does liquidity actually come from? Is it something magical that just appears out of nowhere? Does someone control it? What is it? Really, there are three sources of liquidity in the market. And that is, number one, the real economy. That's where cash actually does its work, where people make transactions, they buy and sell products and services. And when you have those transactions, they can create profits or losses for businesses. And that free cash flow eventually goes somewhere. And you'll see where it goes in a moment. Central banks have an ability to intervene into the market directly. They can push a button and change liquidity conditions very quickly. And I'll show you why in a moment as well. And then there are the credit markets. Now, the credit markets have several layers. I like to focus on the corporate credit market. There are other credit markets such as the mortgage market. There's the consumer credit market. But the corporate credit market is what really moves asset prices, and I'll show you why in a moment too. In particular, I like to look at junk bonds, the low-quality corporate credit. So let's move on to the reasons why these are important. Now, the sources of liquidity, the number one source is the real economy. When employment is strong, people have plenty of jobs, and people aren't getting fired or laid off. That means people have jobs, which means they have money coming in, and they have money that they can send into retirement funds, 401k investment plans, pension funds that are run by the company or a bank or the state. And they're getting regular inflows of cash, those funds, and that cash will go into financial assets. They'll go into bonds, they'll go into stocks. When people have jobs and the economy is strong, you get an inflow of cash because people have cash from their jobs, so they don't need to sell assets. Now, when people start losing their jobs and unemployment starts rising, you start to see stress on people's financial conditions. People without jobs can't buy assets. They can't buy stocks. They may not even have a 401k anymore because it was linked to their job. So what happens is if they don't have a job and they don't have income, they need cash. And so they may need to raid their pension funds, their retirement accounts, to get cash to cover short-term obligations until they can find a job again. Now, I don't know if this is still true, but in recent years, and for a while actually, people can borrow from their 401k accounts, and as long as they repay that loan from their 401k, their retirement accounts, within a year, they don't have to take a penalty on an early withdrawal from that pension fund, from that retirement account. So what happens is people might borrow if they don't have cash because they don't have a job or their business isn't doing well. They might borrow from that 401k, but the bank may not approve the loan on that 401k if the money in that fund, retirement account, is in risky assets like stocks. So they may be forced to sell stocks before they can get that loan and send money into safer assets. So when that happens, when people start losing jobs and the money flows in the other direction, liquidity can come out of the market. And people need to sell assets to raise cash. The same can happen to entrepreneurs, business owners. When they're making money and profits, they'll send all that excess cash into financial assets, or they'll start new businesses, which create new jobs as well, which create contributions to retirement accounts by employees. On the other hand, if the economy weakens or their business doesn't do so well, and they can't get credit through traditional means because credit is tightening, they may need to sell financial assets to raise cash to meet their short-term obligations, to stay in business, basically. So when the real economy gets stressed in that regard, and this is important, and credit markets become tight so they can't borrow on their existing assets, they're forced to sell those assets to raise cash. That creates weak liquidity. And that you can see that translate into the stock market. Now, central banks play a big role here because they're basically, they set monetary policy. They can inject liquidity or withdraw it from the financial markets with the push of a button. And this is worth noting. It may sound a bit strange, but there's actually no such thing as money anymore as we used to know it throughout history. What we call money today is actually credit. Now, what is credit? Credit is a number in an account that can be turned into a debt, that can be turned into a debt to someone else, or that can be turned into a debt to you. So if you have credit, you can access that credit at any time and turn it into debt and use that to buy products and services or meet obligations. Today's money isn't actually backed by anything. It's just numbers in a system. It's not something that's sitting in a vault. We don't have gold sitting in a vault backing our money anymore. It's just credit. It's numbers in a system. And I say this because it means that it can be created anywhere at any time by central banks by pushing a button. They can create credit. And when they create credit, they're actually creating money. And that's why I make that distinction. Money's credit, credit's money. That's the way it is today. So when central banks inject liquidity into the system, they're really adding cash into the system. When they take liquidity away, they're taking cash out of the system. And I'll show you the implications of that in a moment. So credit markets are really interesting. And I like to focus on the corporate credit market here because stock buybacks have been a big driver of stock prices for a while now, for at least, especially for the past decade. And what happens is these companies, what most people think is that these companies have a lot of cash and the companies are using this cash to buy back their stock. And that happens sometimes, but what's really happening a lot of the time is that these companies have investments somewhere else. They may have bonds. They may have money that's actually overseas and they don't want to bring it home because that triggers a taxable event. They have to pay tax. Many other reasons. They don't want to use their actual cash. So what they do instead is they borrow money against that cash. They sell bonds. They sell corporate bonds. Bond investors buy those bonds. They give the company cash, and then they use that cash to buy back their stock. Okay? Essentially, the companies are monetizing their assets through debt, through credit, to enable those stock buybacks. Now, when the corporate bond market becomes weak, and we see that happen first in the junk bond market because it's the weakest portion of the corporate credit market. That's why they're called junk bonds. They're the lowest rated corporate bonds. So when there's weakness in the corporate credit markets, it shows up in the junk bond market first. Now, when corporate credit weakens, guess what happens? Companies can't really can't borrow so easily to buy back their stock anymore. So the stock buybacks have to be either delayed or stopped altogether. Now, corporate buybacks have actually been the marginal net buyer for the bull market for the past 9 years. Ever since 2010, they've been the consistent net buyer of stocks for the past decade. If there were no corporate stock buybacks, net money flows through the stock market would actually be negative. And the participants in the stock market are, of course, individual investors, hedge funds, pension funds, foreign investors, and corporate trading desks. Now, many individual investors and hedge funds have been net sellers of the stock market for the past decade. For several years, foreign investors were net sellers. That changed recently, but foreign investors were net sellers of the stock market as well. Corporate buybacks have been so big for the past decade that they've been enough to create a bid under the market and counteract all that selling, and in fact, create a net positive flow of money into the stock market. So when credit markets weaken, stock buybacks have to be scaled back, have to be scaled down, which creates less demand and less support in the stock market, and that weakens liquidity. It increases volatility. So what does this all mean? Well, imagine we're playing a game of Monopoly, and I love using this example because really it's so much like the world we're in right now. So imagine we're in a game of Monopoly. In Monopoly, you have a banker and you have other players, and they're there to buy properties, develop properties, and collect income off those properties. And I'm sure many people listening to this video have played the game Monopoly, or at least familiar with it. Now, Monopoly has some pretty flexible rules. And something you can do is decide how much money each player starts out with. So if you have a game where everyone starts with a lot of money, well, they're going to buy every property they land on the board. Every time they land on a property that hasn't been bought yet, that becomes a buying opportunity, and they just buy it because they have so much cash. And there's no reason to hold on to that cash when there's so many properties ready to be bought. So every move becomes a buying opportunity, basically, when there's a lot of money in the game. Now, when there's less money in the game, people have to be more selective about which properties they buy. They have to plan ahead and just buy a few because they don't have enough cash to start off with. So that's pretty much like it is in the real world. In the financial markets, central banks determine how much money is allowed to be in play at any given time. And when there's a lot of money in play in the game, investors have plenty of cash, and they don't feel compelled to sell their assets anytime they get into trouble. So what they do is they just buy whatever is available. Anytime you get a little pullback in the market, they buy. Anytime they get a reason to buy stocks or real estate, they just buy because they have the cash available. So when central markets inject a huge amount of liquidity, there's a lot more cash in the game. So, the players in the Monopoly game, they're just going to buy more properties anytime they land on a space that lets them buy a property. Now, something else that the central banks do, in the game of Monopoly, if someone needs to raise money, they can mortgage their property, which means they can turn that property into cash, but at a very high interest rate. Now, if the Federal Reserve lowers interest rates by a lot, basically to zero, that means no one really has to sell their properties anymore. They can just mortgage it, get free money out of that property, and they don't have to sell it. So that's pretty much what happens when interest rates are low and monetary policy is easy. People can just monetize their assets by borrowing against them, and they don't have to sell them. So in Monopoly, you also have something similar to liquidity flows. Every time you make a trip around the board in Monopoly, you get to collect $200, and that gets added to your cash pile. So this is similar to what the real economy does. When the economy is strong, It's businesses are generating positive cash flow, and employees are making money that they can contribute to retirement funds. So as time passes in a strong economy where corporate profits are, pretty generous, that free cash flow is available to be sent into financial assets. So the real economy is kind of like pass and go. And when you have a good economy, you're collecting $200. When the economy gets weak, you might start collecting, say, $50 or $0. Or if it goes into recession, guess what happens? Every time you make a trip around the board, you have to pay $200. So the economy isn't producing free cash flows anymore. That means people have to sell their assets just to meet their day-to-day obligations if the economy goes into recession. This is important, okay? So that's the effect the real economy has on liquidity flows. The real economy has an effect in relation to the passage of time. So say the economy is booming and profits are enormous. You might get a situation where every time you pass go, you're making $500 or $1,000. In those cases, people have so much money, they just dump it into whatever assets they can find, and that's what creates those situations like, say, the dot-com bubble, for instance. Now let's talk about QE. Look, central banks don't like to use the word quantitative easing anymore because it has a bad reputation now. It's bad branding. So they just call it liquidity injections now. And QE is liquidity injections. They're pushing a button and creating credit, which is basically creating cash. And they're adding extra money to the game of Monopoly, which means they're adding extra money to the financial system. So when central bankers start a QE program, a liquidity injection, they give everyone in the game, every player in the game, extra money that they can use however they like. So with all that extra money, all these institutions, all these banks, all these big investors, they have plenty of cash and they don't know what to do with it, so they just hold on to it until an opportunity appears. And if there's a sudden stress in the market, a sudden crisis, well, they don't feel any need to sell their assets and liquidate them because they already have plenty of cash. And if they need more cash, there's so much credit available, they can just borrow on their existing assets. See, so there's no selling. So let's move on to QT, quantitative tightening. Now, when the Fed removes liquidity from the system, that's basically what it is. It's go directly to jail. Do not pass go. Do not collect $200. That's exactly what it is. What the Fed did last year is they removed money from the game. Okay? When the Fed reduces their balance sheet, they're really taking money out of the game and limiting how much money players can have in the game. Now, in Monopoly, if you limit how much money people have, and there's a shortage, let's say you don't have enough money and the available money is declining because of the Fed, because of the banker. And suddenly you land on a property that has a hotel. Now, when that happens in the game Monopoly, it means you have to pay a huge amount of money in rent. Now, in a normal economy or when liquidity is strong, you have that cash available, or you can borrow against your existing properties and you can pay the rent and just move on. But if there's a shortage of money because liquidity is being removed, see, what happens? You don't have enough money to pay that rent right now, so you have to sell assets. Now, you might mortgage assets, but so that you don't have to sell them. But when liquidity is being removed, interest rates are also going up. So it becomes expensive to borrow against those properties. So instead, you just sell them. You're forced to sell them to meet that obligation. And that's what creates the runaway spirals in the game of Monopoly that takes players out of the game. And that's what creates the runaway sell-offs in the market. In the stock market. People are forced to liquidate because they can't find enough cash to meet their short-term obligations when the market starts selling off. When there's a sudden shock in the market, they don't have the cash available to meet that obligation immediately, so they have to sell assets. They sell their stocks. So what does all this mean? We've talked about so much. What is the one key insight that we can get from all this that we can use to take our trading to the next level? It's this. If there's one key insight, it's this. Liquidity determines how the market reacts to stress. When the market gets stressed by bad news, by financial shock, anything you can think of, it can decide how it reacts to that shock in a variety of ways. But once that shock makes it through the system, what happens to asset prices? Do they stay stable? Do they recover quickly? Or do they just crash because people can't handle the shock from the news? Well, liquidity tells us what happens when there's stress. Tells us, are these big support levels going to hold and produce big reversal rallies? Is the market going to stabilize when you get that big pullback in response to this sudden shock, this sudden crisis? Or is the market just going to crumble? There isn't enough liquidity, and the sell-off, because of this bad news, is forcing people to liquidate their stocks and raise money to meet obligations elsewhere. This is what liquidity is about. It tells us what happens when price moves to these big levels in the market, regardless of the news, regardless of what's happening anywhere else in the economy, the market, the world, and politics, anything, it doesn't matter. Liquidity tells us what is likely to happen once price has made its big move in reaction to that news to a major level. Will it recover quickly and promptly? Will it chop around while it consolidates and absorbs the news, or will it just totally collapse? That's what it tells us. And that's all we need to know to make a fortune. We just wait for those events and then look at liquidity and then decide, is this where I make my move or should I wait? That's it. Once you have the answer to that question, you have the potential to make a fortune. So this is what liquidity tells us. So I like to liken, liquidity is this nebulous concept. We don't really see it. We can't see liquidity in the market. It's kind of like the wind. With the wind, you can't actually see the wind, but you can see the effect that the wind has on the world around us. When the wind is blowing, we can see leaves fluttering. We can see flags waving when they're raised up high. We can see objects in the ground being blown around. We can, based on observing these leaves, these flags, these objects that are moving around, we can confidently say, how strong is the wind? What direction is it blowing in? We can look up at the sky and see the clouds. So, where is the wind going? Where is it coming from? Now, liquidity is like the wind. We can't actually see liquidity, but we can see the effect that changes in liquidity have on the market. We can see the effect on the junk bond market, for example. We can see the effect of liquidity on very sensitive parts of the stock market that get tossed overboard first when liquidity is weak, and they get bought first when liquidity is strong. We can look at all these factors, all these data points, and find out, what is liquidity doing? Is it strong? Is it moving up? Is it moving down? Is it stable? Is it unstable? And the market conditions index, the MCI algorithm, it lets us see the wind. We can see what is invisible to almost everyone else. And that is as close to an unfair advantage as I could ever imagine in the market. It's almost unbelievable when I think about it. The key is waiting for those key moments, those key inflection levels that the market gives us, those key inflection points where liquidity comes into play. the major support levels, the huge breakouts. That's when liquidity tells us what is probably going to happen here. And that's when we can make our big, confident moves with conviction and as close to surety as we can get in the market. And those times are when we can create our fortunes. And so we're actually developing an app. Speaking of the MCI, we're making an app for mobile devices, both iOS and Android. And once it's done, I think it'll be done in a few months, you will be able to see on your strategic trading app, the MCI, you'll be able to see a whole section just on liquidity and the different parts of the market and what liquidity is doing. And this will be available to you on command. And that's nice, the water on the smartphone screen. That's liquidity right there. So that's going to be available, I think, early next year, probably January, February, March. We need to make sure it works perfectly before it's released, but that will be available to our members. They will be able to access the MCI on their phone. You have a question about liquidity, it'll be right there. So that's it. That's the basics of liquidity. So next time I say the word, or anyone says the word, you'll pretty much have a good idea of what we're talking about, or you'll know if the person saying it knows what they're talking about. So if you have any questions, feel free to post on the Strategic Trading community. That's the forum for members. And we'll be releasing more and more of the MCI as time passes. Right now we're showing the short-term, long-term, and medium-term charts. There's much more to it. There's a lot of historical data, and we're building new applications for that data over time. So you'll have access to that, especially on the app once it becomes available. So hope you found this helpful. This is our first presentation video. We'll make many more of these. If you have a specific request for one, just mention it. And until then, be well. I'll see you out in the market.